Hello and welcome everyone to another episode of Kuvera Insights, where we talk to industry leaders to learn more about how to better manage our wealth. Today we have Mr. Ankur Thakore. Welcome, Ankur. Welcome to Kuvera. He brings with him 23 years of experience in sales and distribution, channel management, portfolio management, and product development across names that every one of us knows about: Fidelity, TSP, Merrill Lynch, Kothari Pioneer, and HSBC Asset Management. Ankur is a Bachelor of Engineering from Mumbai University and a Master's in Management Studies also from Mumbai University. Welcome, Ankur. So, coming back, trading is picking up in India, right? You're an individual trader. Why should you not do arbitrage? I mean, I can go and sell futures and buy stocks. How does having a fund structure make it much better for even the end user to say that, hey, you know what, instead of me spending my time doing this arbitrage myself, I should still give money to these arbitrage funds and I'll be better off?
Sure. As in, if you have the expertise, you can surely do that. But many a times what happens is, one, that you can't do arbitrage across 50, 60, 70 stocks. You
True.
end up doing it for one or two stocks in a best case scenario. And you don't have screeners which are on an instant basis giving you pop-ups as to where the arbitrage is lying to be the most. So in effect, yes, if you are happy doing arbitrage on your own, for a single stock, it's okay. But my sense is, because there is
I'll also
diversity,
add one more thing. I mean, the short-term capital gains tax will eat up most of the returns. As
which
an
I think
individual,
and
as an
there is a cost.
individual,
There is a
yeah.
cost of trading as well. As it's not just the short-term capital gains. At the end of the
No, no.
day,
See,
yes,
what happens is what I was trying to say is that as a fund, you don't have to pay. You can
agree.
churn. You're,
Yes,
you're churning tax free, but as an individual, if I do it, say I build up a algorithm and I connect it to to some automated provider, and every month I'm squaring off my positions, I'm still paying that 15% STCG. So as an individual, unless I think what Uncle was saying, if you can build something more sophisticated, then there might be a bit more a more quantitative and more sophisticated, then you might think of doing it yourself, but then the bar is really high.
and the other thing is, Gaurav, the fact of the matter that yes, it's LTCG, but anybody who has a trading volume of more than 1.5 crores in a year in India, that automatically gets treated as income,
Right.
and
Okay,
and
so then it gets taxed
taxed at the marginal
even
tax
higher.
rate.
Yeah. Then
So
it then you're better off with a savings fund, or giving money to a
agree.
fund house like yours to your to do the arbitrage. So makes perfect sense. Now coming down to how does then an individual portfolio, an individual investor, how should they think about arbitrage fund in their portfolio? What do you think is the best way to contextualize what an arbitrage fund is? It a replacement for debt in your portfolio? It's a replacement of, is it a low risk equity play in your portfolio? Is it a mixture of the two? Given the taxation of arbitrage funds, what kind of duration makes most sense for arbitrage fund? If I'm investing in an arbitrage fund, should I be thinking of 3 months, 9 months, 3 years, 6 years?
Sure. So I would take this as a replacement for short-end debt requirement. And when I say short-end, I'm talking about, say, 6 to 12 months or 3 to 12 months kind of an investment horizon. So typically money which is parked in for saying, okay, I may need for my vacation happening 10 months later. Yeah, we are in COVID situation, so it's difficult to put that
I
timeline.
know.
We don't know when we're going to travel, but yeah, in most normal circumstances, you have say, okay, I've got to travel 10 months later. This is my cost. I'm putting it aside instead of leaving it in a bank account or leaving it in a ultra short-term fund of a mutual fund. This becomes a good alternative for two reasons. One
Right.
is that today, when we look at the current spread which is available, in absolute terms, is much higher than many of these products available. So if your ultra short-term funds are giving you an yield of say 4%, the last 7, 8 months of arbitrage fund spreads have been in excess of 5%. So in
Right.
absolute terms itself, you are at a higher level. And second is that your ultra short-term fund obviously is not going to get the benefit of capital gains tax because it is only for a 3 to 6 months. So you get taxed as marginal tax rate. So if you are especially in the largest bracket of 35% plus or 43% plus, your returns are actually 2.5% if you have a 4% gross return. Whereas in case of these kind of products, you end up having a taxation benefit because your short-term capital gains because this falls under the equity category. Your short-term capital gains is at 15 plus surcharge, so it's about 17% of taxation. Even for a mid-size SME corporate where you have taxation of 25%, it still is effective. So one is the HNI, it's surely far more effective. Even from a taxation from an SME perspective, they're looking at parking the money to 3 to 8 months time, which is like the more working capital that can also be looked at. We haven't seen a very large explosion on that part as far as Indian industry is concerned, but the HNIs are kind of gradually picking this up as a product.
That's what I was going to ask, right? Like, I mean, given that last 1 year interest rates are coming down and markets have held up, like you said, arbitrage opportunities are there. People are bullish on the equity side. So, are you seeing a lot more people realizing the value of arbitrage fund on the short end of the investment needs? Are the disproportionate flows starting to come in, or still there's more work needs to be done in educating people about what arbitrage funds are?
So, if I have to look at it from the size of the market in terms of the new flows coming into the industry, has been improving over the last 6 7 months. But there
Right.
is a long way to go for us. If I have to look at from a number of customers coming in, as in that's one barometer, it's probably not yet reached even to the liquid fund level, where everybody is today aware of a liquid fund. Even if they want to park the money for a short period of time, they tend to park into liquid. So it's very easy to convince people. One, obviously the liquidity is far higher as far as liquid fund is concerned. You get money in T+1, which means that you redeem today, tomorrow morning you have money in your bank account. When it comes to arbitrage, it's T+3, which means that you will get money with a 2 more day lag.
It follows the equity settlement, I would think.
It follows the equity settlement, and hence it comes at a T+3. So in that sense, there is a bit of a delay. So people don't replace liquid with this, but people replace typically the money market fund or the ultra short-term fund or the low duration funds with the arbitrage category. Um, I'm gradually seeing the move happening now with, say, the smarter and well-informed investors. It's not yet become a big trend as that everybody is buying into it. So
I
that's
mean,
something.
that's one thing that also sometimes, I mean, not a lot of industry people talk about arbitrage funds. I think there's something, because I think a lot of these, I mean, I think of financial education, financial inclusion, whatever the big term you want to use, doesn't matter. But reality on the ground is still a lot of people start talking about something. It's very hard um, to get a clear. Otherwise, what happens is it just gets lost in all this noise, right? I mean, for example, right? I mean, think about hybrid funds, balanced advantage funds, and so on and so forth, right? It was almost like a concentrated industry effort, like the largest fund houses got together at pretty much the same time. I don't know whether it was planned like that or it just happened like that. And suddenly everyone kind of realized, oh, okay, you know what, there is an asset allocation play here and you can do it in different ways. There is, then you get into the merits of whether you should do aggressive hybrid or balance advantage and this, that, and the other. That doesn't matter. But I think for arbitrage, something similar is needed, something where the education happens at a level that a lot more people can understand it clearly. Because I'll tell you very honestly, right? I mean, I have a financial background. I hear the word arbitrage. To me, it makes complete sense. I know exactly what you're talking about, right? Basically, not taking any economic risk, but there is a possibility of making money because of the two different instruments you're using. Right? Most people don't understand that, right? So most people, for them, the word arbitrage itself, I think, is a bit scary. Is there a simple way of saying this? And I'm not joking. Like,
But I
seriously,
agree.
is there a way to make it? Because actually, it's a very good product. It's good for the financial markets. It's good for the end user. It doesn't carry the same amount of risk that some of the other. I mean, it has risk. Every fund has risk. So
Correct.
the ARP can blow up, but I'm pretty sure you guys will manage that by saying none of the ARPs can be more than 2 or 3% of the book. So there are ways to manage it that everyone does it. So, but it just doesn't get talked about as much in retail forums, in retail space.
Right. I think there are 2 or 3 things where I believe. Firstly, as you rightly said, arbitrage as a word, unfortunately, resonates more with in the Hindi term satta. Are you doing something
Huh,
which is like a trader,
right.
or you are doing something which is more fundamental in nature? truly we don't do any fundamental research on a company, but it is not trading that we are having an open or a naked position which can blow up.
Ah,
It's a fully
right.
locked in position. So that's the kind of education which needs to get done. I think a platform like yours can help us to at least start off on that piece. The second reason why I think we haven't done much is till now we've always believed this is a product which is more HNI and premium HNI product. We have not yet got into the retailization of it because somewhere we were more focused on getting money in the liquid, which is easier one to explain.
Right.
I think today we have seen the penetration in liquid. Today, with number of SIPs which get signed up in liquid funds have also increased, and
Yeah.
that's for the education which has happened through. I think that's a process which we will go through, and it till now we had fewer players in the arbitrage fund as a industry. So there are 42
I'll
asset
also
management.
add one thing here, just for the liquid fund piece. I mean,
Yeah,
and again, I mean, you might take this back to for a product development, but Insta-redemption I thought was a very smart move on the liquid fund play, where they said that what, anyways, it's not like we are let's bring the true convenience
true.
short-term investing where the money is available on demand. It's not the entire amount, but 50K is a large enough sum. It's available
Agree.
on demand. So anyone who has any apprehensions of their money being logged in, even for T+1, now it's like, okay, you know what, when you need the money is available. So this becomes a almost like a quasi deposit account in the investor's mind,
Agreed.
but with slightly higher rates. I don't know if something similar is possible on the arbitrage space, but that would really change how people perceive this.
Uh, sure. I think it's extremely difficult to envisage that from being a liquid asset because at the end of the day, um, by the time you can action that trade and put it into execution, the asset management company will get money back only in 2 days. In case of a liquid fund, because a lot of money is in the overnight as well, which is TREPS or
Yep.
whatever way we want to explain it. These are things which can come to back to the asset management company if they were to trade. So if somebody redeems right now at 8 p.m. in the evening, tomorrow morning I can execute that trade and get the money. Uh,
The cost carries almost none.
Carry is almost nothing. Whereas in this case, there is a carry, and that cost can be borne only by the asset management company. It cannot be borne by the other investors.
Fair
So
enough.
it's good.
Fair enough.
So that could be one of the big deterrents. And today, it's not like a hugely profitable or a huge margin product. These are very low margin products, and that's how you can
True.
deliver returns to the customer. Because the moment you start charging more, the returns of the customers go down. So you keep it at a charge which is reasonable for the customer to participate in. So it's a thought which we should look into. Fair point, as in nobody has really thought, or if people have thought about it, I'm not aware of it, but at least we didn't think about it. We can surely look into it and probably see as to how best we can make this as a product of acceptance. As in what all things can be done which will help people to buy this product far more easily.
Exactly. Exactly. Thanks much, Ankur. I think this has been fantastic. I hope that everyone learned a bit more about what arbitrage funds truly are. They're not taking any. Just want to repeat one line because that's really important. They're not taking stock specific risks, sector specific risks, or economic risk. The positions are completely hedged. The returns come to you because of the difference in the futures market and the spot market, which is the share market. So hope everyone enjoyed this session and learned a lot from Ankur. Thanks, Ankur, for being with us.
Thank you very much for having me here. Much appreciated.